Alrighty, it is 6 p.m. here in New York, and I am David Edwards, president of Heron Wealth in New York City, and I'm going to take some time tonight to talk about where we stand with the coronavirus, financial markets, a couple other bits of information. I didn't get in too many questions today. It's Easter. People, I'm sure, are talking about their families. That's fine. There's a chat function available to you. Submit questions as we go along, and I'll answer them at the end. Any questions I don't have time for today, I will answer in person. Let's begin. Today, we're going to talk about the reason why I titled this webinar, Eye of the Hurricane. As many people know, I'm a sailor, and I spend a lot of time worrying about hurricanes. This is an aerial view of a hurricane heading towards the east coast of the United States, and it swirls in a counterclockwise fashion, kind of like the blades of a circular saw. At the very center there is what's called the eye of the hurricane. And for interesting meteorological reasons, as the eye of the hurricane passes directly overhead, the winds, which might have been 100 miles an hour 10 minutes ago, drop down to 0 for about 5 minutes, or 10 minutes, or 20 minutes, and then come back again to full force, 100 miles an hour, 125 miles an hour. And oftentimes, people are fooled by that eye of the storm. It was 100 miles an hour, now it's calm, and they leave where they're sheltered, they go out, they start checking out the neighborhood, trying to see what their situation is, and they get killed by that 100-mile-an-hour wind coming right behind it. So that's an appropriate place to start off our discussion today. There are two things that happened in the last week that were of interest. One was that we had a monster rally in the stock market, up 12% in 4 days. That's about a 1.5 year return under normal circumstances. That was the biggest one-week rally in 45 years. And people might say, well, does this mean that we're all good for stocks? We can invest with confidence. And then the other thing that happened was there was a glimmer of news that the rate of infections was falling, not gone to 0, just the rate of new infections was falling. And so people think, well, maybe we're past this this virus, maybe it's good to go. So let's spend some time talking about both of those. First off, I'm going to talk about our clients specifically. We have clients that fall into 4 broad categories. 25% of our clients are business owners. I'm a business owner. And obviously it's been a pretty tough 6 weeks for all of us. Some of our families, our client families, have had to lay off 100% of their employees and are somewhat wondering if they'll be able to restart their business. And we've been talking an awful lot and emailing an awful lot about the SBA, Small Business Administration Paycheck Protection Program. Even if you've had to lay off all of your employees already, you should still apply for this program. It works out to about 2.5 months of your monthly payroll from last year. And that could either be money to rehire people by June 30th, in which case the whole loan is forgiven, or it could be capital to restart your business down the road. And by the way, this is a non-recourse loan. If you can't pay it back, there's no collateral up. You're not gonna lose your house, you're not gonna lose your business. It's almost free money. The problem is how to get the money out fast enough. So for example, my bank is Chase Bank, and they didn't even have their website up until Friday to even take loans. And I haven't even submitted my paperwork yet. I will. It could be several weeks before I hear back what the story is. At that point, the current amount of money could be exhausted. Well, there's more money coming. So if you're a business owner in our client pool and you haven't taken advantage of this program yet already, and you need information, call me or call Chris Jennings in my office. About 35% of our families are currently employed and their jobs are mostly secure. Some of our younger clients have already been furloughed or lost their jobs, and that's no surprise. It's going to be tough. But for our executive class families, they're still getting paid. Maybe they're going to get paid less this year, but they are getting paid. And that's good news. And mostly we're just maintaining their investments as they are. Probably the clients that took this news the hardest were the clients that were within 1 to 3 years of retirement. They could see the finish line, they could see the goal post, and it was close enough to taste, and now maybe we'll have to wait an extra year or two. I've already heard from from one client that she's going to postpone her retirement by a year. That's not to say you'll never be able to retire. It just means it's going to take a little bit longer than we planned even 2 months ago. And then among the 40% of our clients that are already retired and are depending on their portfolios for their monthly draw, yeah, we paid out their monthly draw April 1st as expected. May 1st draw should go out as expected. June 1st, July 1st, August 1st. And as I've said on numerous occasions, we can do that because we have a year's worth of cash in short-term government securities, another 4 years in bonds. Typically a big bear market like this, the recovery is only about 3 years. So by the time we need to start reloading the cash in the bonds, the stock market should be back up again. All I've done for the last 5 weeks is answer questions and phone calls. So if you haven't spoken to me yet or need to speak to me again, just pick up the phone and call 917-705-3893. I'm working remotely. My team's working remotely, but we have 100% of our normal capacity. Coronavirus, the worst is yet to come. I got some criticism after my last webinar. Someone let's talk about the best case scenario. And we're going to jump over to a website in a moment called Worldometer Coronavirus, Worldometer Coronavirus, and look at actual charts of how things are going. So China and South Korea. China aggressively restricted movement. South Korea had testing in place. They beat this thing to death in about 2 months. And China is already restarting its economy. Spain and Italy, that's a bad case. About 37,000. Okay, I just got a message that the slides didn't come through, so let me just address that. Give me a couple seconds here. Okay, so China and South Korea, the best case. China aggressively restricted movement. South Korea had great testing in place, great medical in place, able to beat it down pretty quickly in about 2 months. Italy and Spain, a bad case, 37,000 deaths combined. That's 10 times China. US right now is looking like the worst case. 1/3 of world cases right here in the US, 22,000 deaths so far. 100,000 to 200,000 deaths not out of the question. I just don't know what else I can say about our situation, but we'll look at some charts and you'll understand where I'm coming from these numbers. This is the coronavirus website and worldometers.info/coronavirus. I look at this every single day. And this is the chart for the whole world right now. Maybe make it a little bit bigger on the screen. And it's going straight up. And even if we convert to a log scale, which is a tool to measure rate of change, what we see was that back in January, this thing started out in China, leveled off for a couple of weeks, but then caught fire in Europe, caught fire in the US, and just took off. And we see deaths following accordingly. So that is not good at all. Until this number here flattens out, we are not safe. Let's look at countries specifically. I'm going to go directly to South Korea. That is the absolute best case. 214 deaths, 10,000 cases. That's a 2% mortality rate. That's pretty good. But most importantly, look what they did. They tested aggressively. They had good health care. Within about a month, they brought this thing to a near dead halt. And you can see it in the daily new cases, drops off dramatically. And you can see it in the new cases. And you can see it in deaths. Still rising, but at the rate of 3 to 5 a day. That's not bad. Let's take a look at Italy. So a little bit of good news. Their new cases are flattening out, still rising, about 5,000 a day, but at least flattening out. And so you can see it here in the number of new cases per day. And it's about a month from here to here, which means that a month from now, if all goes well, their chart will look like South Korea. Deaths starting to level off, but still adding, 400 to 500 a day, 600 a day. The only good news is that the rate is not increasing, it's falling off a little bit, but it's still substantial. Italy is a solid month to 6 weeks away from looking like South Korea. And now we're going to look at the US. Right now, we're number one worldwide. 2,000 deaths a day, that's the highest number out there. Total cases, that's the highest number out there. New cases per day, that's the highest number out there. And the reason why is because we have a highly mobile society, and the initial infections seem to come actually more from Italy and Europe than from China, but started out in New York at JFK and Newark and spread across the country like wildfire. And almost no county in the country is free of the coronavirus at this point. And so if we look at our charts, these are all by states, we see barely falling off, still adding quite a few per day, very high numbers. Best you can say is that it's leveled off at 30,000 new cases a day. Imagine the load on our hospital system. Active cases, new deaths per day, very high. Best you can say is that the rate of new deaths has leveled off at around 2,000 a day, but that's 10,000 people every 5 days. That's 60,000 people per month. And we are a solid month behind Italy. So we have 6 to 10 weeks to go before our curve levels off. And so any discussion about reopening the country and getting everybody back to work seems grossly premature. I don't know how we can possibly solve this thing if everybody goes back to work like they're supposed to. For my team, for example, this is how fast things were moving. We hosted a client event on March 11th. On March 14th, I closed the office for 1 week. On March 15th, I closed the office for 6 weeks. At this point, I don't intend to reopen our office until either we have the vaccine for our team, or we've all had blood tests that show we have the antigen, the antibodies in our blood already because we've already been exposed. So that is tough. Anyway, as I said before, I'm not an epidemiologist. I don't work for the CDC, but I am very good at reading charts and data, and this data is disturbing. All right, so the markets sold off dramatically. 34% decline from the record levels on February 19th to the March 23rd low, rallied 24%, 25% through this past Thursday. On a normal year, the stock market goes up about 8%. So that's 3 years of return in 3 weeks. But still, the market would need to grow another 21% to make new highs. But here's what's driving all this activity. First off, enormous contribution from the Federal Reserve, injecting $2 trillion of liquidity into the banking system, into small business loans. Yields are about as low as they can possibly get. Federal Reserve has been very supportive of the bond markets. The bond markets have not crashed the way they did in 2008, 2009. The banks have plenty of liquidity. They're not leveraged the way they were in 2008, 2009. So the banking system is not at risk. What is at risk is everything else. You know, if my team doesn't go back to our office until December 1st, well, that means we're not using the subway. We're not buying lunch at Midtown. We're not having a drink at the bar afterward. We're not buying clothes or taking our shirts to the laundry. We're not contributing to the economy. And so we already know that the next unemployment report is going to show about 10% unemployment rate, could be as high as 15 or 20% by the summer. That is just a staggering punch to the face that is really unprecedented. And so if the markets, you know, right now the markets are kind of on a little bit of a high from, I'm getting a text message from my team. Let's just double check what that is. Yes, so I got a note that some questions are coming in, and we're gonna deal with the questions at the end. So historically, it takes about 3 years to recover from a bear market. That's what happened after 2008. That's what happened after 2002. That's what happened after 1998. That's what happened after 1987. That's what happened after 1974. But we'll see. We'll see. So the financial markets may swing back the other way. Right now, short-term trading is driving a lot of it. The fact that the stock market did so well last week was probably short covering. Less money coming in, more people had shorted the market and now had to cover their shorts. So what that means is that we've adjusted portfolios where we need to. We've talked to certain clients who needed to raise cash because their business needed cash. We're taking some time now to look through existing stocks and see whether certain stocks should be sold, other stocks should be bought. And it's not a turn on the dime kind of thing. But frankly, that's all my team and I are doing between now and the end of the year, is just seeing what we can do to do the best for our clients and their portfolios. Let's talk about the US presidential election. And again, I get a lot of criticism for writing about politics. People feel that I am too partisan about it. And all I can say is what the president does has enormous impact on the economy, and we need to consider it. And certainly, if the current president had taken more time back in January to understand the risk that the country was facing, we would not be in the current circumstances. But alas, he did not, and now we are where we are. So right now, Trump is polling at 44.4%, disapproved by 50.7%. And that's pretty consistent with how he's polled for the last year. Trump's numbers went up for a couple of weeks as he became the wartime president dealing with the coronavirus. But now, as the response has proven to be inadequate, his numbers are starting to fall. And these polling numbers come from 538.com, which is a very good polling site. It aggregates all the polls together. There's generally a 2-week lag between what's actually happening in the real world and what the polls say. Trump has polled consistently at these levels for the last year and a half. And it seems like opinions about him are locked in. Either you like him or you don't like him. We know that Joseph Biden is the Democratic nominee. So far, he's been very quiet, almost like he's just letting Trump do his thing and he'll pop up later this summer. We do know that the Democratic convention was pushed back by 6 weeks. Originally, it was scheduled ahead of the Republican convention, but now that the Olympics have been canceled, it is scheduled after the election. And the most interesting thing is going to be the Electoral College math. In the last election, Trump lost by 3 million votes, but won the Electoral College math. This time around, I think he could lose the popular vote by 6 million votes and still win the overall election. So we're going to do a little bit of a electoral college math game and see exactly how that could happen. And so this is from a website called 570 to win, 270 to win. And this default chart here, I'll make it a little bit bigger, is the consensus of multiple, it's the Cook Political Report, it's the Virginia Center for Politics, a couple other centers. The consensus is that Trump will win all these states in red right off the bat, and the Democratic nominee Biden will win all the states in blue, and the only question is whether how these particular states turn over, these states that are in beige. So you can actually flip them one way or the other. Right now we think that Florida will go to Trump. He moved there recently. He's still popular there. We'll see what happens when the mortality starts to rise. We think he'll also win in North Carolina. So that takes him up to 248 versus 232. We think that the Democrats will win in Pennsylvania, and we think that the Democrats will win in Michigan. So that takes the Democrats to 268. And as the website says, it takes 270 to win. So if the Democrats get Arizona, which is a good chance they win, or if they get Wisconsin, there's a good chance to win. And so needless to say, Wisconsin is probably the most critical state in this election. And if the Republicans have to get both Wisconsin and Arizona to win. Nope. Oh yeah, there's a couple of sideshow states. There's Nebraska. Let's give that to 100% to the Republicans. Yep. So that would take, Nebraska actually has a split electoral vote. You can have a couple of votes going to a Republican or a Democrat. Anyway, so the Republicans have to win all that. So now you see it's an election down to 270 versus 268. So we do not know at this time who the next president is going to be. It is no secret to my readers that I do not hold Trump in high regard, and I would be thrilled if there was another president in place. And if you agree with me, and you happen to live in these swing states, by all means, go out and vote Democratic. And if you don't live in the swing states, but you have the ability to send money or send letters or any help, whatever, you should go for it. All right. And again, I get criticized for having an opinion about politics. Right now, we're looking at a pretty vicious stock market situation, 10%, 15%, 20% unemployment, US GDP down 10%. That's a pretty disastrous outcome. I don't think that we would stick with someone who was a president, was a chairman of a S&P 500 corporation who delivered such awful corporate results. Not sure why I would stick with him as a president, but we'll see. Okay, going back to the tail end of my presentation. We are on time. We are exactly on time. So now I'm going to take a look at any questions that came in. And the first question I'm going to address came in this morning via email. Hey, David, is given that you think that the stock market could retest the lows, is there a way of hedging my portfolio so that that we don't go back down again, but then still preserve the stocks from going up again? So there's a couple ways of doing that. None of them very satisfactory, but I'll go down the list. First off, sell all your stocks now, buy them back later. Well, we could do that, but typically that incurs a pretty big capital gains tax, and the probability of getting back in at the right time is low. For example, in the last 3 weeks, the market was up sharply on week 1 and week 2, and I would have bet that the market would have sold off on week 3, but instead it rallied even more. So if you had sat out those 3 weeks, you'd be behind by 24%, you'd be behind by 3 years. It's impossible to make that up. But that's one possible solution. Another solution is to buy put options on the S&P 500. Well, those put options are very expensive right now, and the people who sell those put options are no dummies. They price them so that they win and you lose. So even if you're right on direction, you'll still be able to make it up on the price. A third option is to short S&P futures. That is not an available option in Fidelity brokerage accounts. So we're not going to offer that. And then the final option is to buy a certain kind of ETF. It is called a ProShare Short S&P 500. You can also get a short QQQ. And the idea is that this is an inverse ETF, so it goes up when the S&P goes down, hopefully in a 1-to-1 ratio. So if the S&P goes down 10%, the ProShares short S&P will go up 10%. But again, it all boils down to timing. Let's say 3 weeks ago, I had hedged out this client's portfolio with the ProShares. Well, I would have gained on his stocks, but lost on the ProShares, and he would have been hedged against profit. So none of those are satisfactory solutions. Be happy to talk about them further one-on-one. Let's see what we got for questions. So the first question is from Mike in New York. Trump doubled the national debt before this. Now it will grow 2 to 4 trillion more plus addresses in the coming 5 years. You know, this is the most interesting issue. Once upon a time, people worried about the deficit and worried about the national debt growing so large that it crowded out conventional borrowing. No one's going to worry about that right now. The national debt was about $11 trillion before the start of this. It will be $15 trillion by the end of the year. It'll be $20 trillion by the end of 2021. And that will be about a ratio of 2 to 1 between national GDP and national debt. And historically, once a country gets over 100% or 110% or 120% ratio of debt to GDP, they get into a slow growth trap they can't get out of. Japan is a classic example of that. What is actually more applicable is how national debt grew during World War II. It exploded. Essentially, the U.S. financed the war with borrowing, and then paid it off through the 1940s, 50s, and 1960s. So it may well be that we end up with a $14 or $20 trillion debt, and then we have to deal with that debt by increasing taxes and changing the capital gains rate and doing a bunch of other things and paying that back over time. So a question from Alex. Singapore just went into its second lockdown. Can the US afford a second lockdown? What is the long-term outcome of the COVID crisis in the US? Herd immunity versus vaccine versus South Korea. So here's the problem. If, just like we're talking about, the eye of the hurricane, you get through the first cycle, the rate of infections drops down, the rate of deaths drops down, people go, hey, all clear, and they literally go outside and resume their normal lives, and the coronavirus hits again. You know, and by the way, everybody needs, I mean, let me just say that I underestimated this coronavirus back in February. A client wrote to me and I said, was I concerned? I said, no, SARS, MERS, Ebola, H1N1, swine flu, all these diseases come and go, and it's not a big deal. Well, this coronavirus is a big deal because it's 10 times more contagious than anything we've seen before. It's 10 times more lethal than the conventional flu or the conventional coronaviruses. And the worst of it is you don't know if you're infected and you don't know when you're infecting somebody else. So that's why I told my team, we're not going back into the office until we've all had blood tests that show that we have the antibodies in our bloodstream. It means we've been infected already and didn't get sick, but we're okay now. Or alternatively, we get the vaccine. And that vaccine, everyone's working on it as fast as they can, multiple scientists all over the world, multiple countries. The earliest we're going to see that vaccine is January 2021. And then the last question is, what about herd immunity? Yep, for sure. Herd immunity will definitely get out there over time, but with herd immunity comes a lot of fatalities if the mortality rate is 1% or 2% or 3%. We don't know what the true mortality rate is because we don't know how many people have been infected, and we don't know how many people have been infected. It's because we don't have enough tests. So there's just a whole bunch of reasons why our outcome looks a lot worse than South Korea's outcome. Got one more question about why won't Fidelity allow shorting S&P 500 futures? That is just not a service that they offer. And the reason why is because trading in futures is a highly leveraged investment. It's highly speculative. It's highly aggressive. You can lose a lot of money really quickly. And Fidelity has taken the position that that's not a service they want to offer to Fidelity clients. And I don't think I have any more questions after that. Last chance for questions. And if not, I will end this webinar in about a minute. I just got a, oops, I got a raised hand, but what I don't have is a question. The best way to put the questions in is through the chat function. Oh, okay, I'm sorry. There's a second function I better look at called on the chat side, but I don't know where that is. Where is the chat panel? You may be out of luck. Oh, here it is. I found it finally. Okay. Here's a nice question. How's the quarantine going for me? I am safe. I am secure. My team is safe and secure. We've always had 100% preparation for abandoning our Midtown office, which any New Yorker knows is not the best place to be. I take my temperature every day. I have a thermometer and I write down my temperature. And as long as it stays around 97, 98, I'm fine. If it goes up to 99, 100, 101, I would be concerned. Take a temperature. Question about China numbers. Do you really believe the numbers from other countries? It is very good to doubt numbers from China. That's why I actually focus on the numbers from South Korea. South Korea is a modern industrialist country. It's a relatively homogeneous culture. It's a very technologically advanced country, and the citizens respect their government and go along with their government and do what they're told. And that's why they have such a better outcome. Let's see here. Question about, so a complaint about talking about Trump. Yep, I get it. But as I said before, the decisions he makes has had a significant financial impact on all of us, and that cannot be ignored. What stock holdings do you have that you think will do badly in the post-pandemic? I'm not going to talk about this too much. I will say that historically we have not owned cruise ships or hotels or airlines, just because in good times it's hard to make money, and in bad times it's just bad times. So that was good news. Amazon has done very well for us. Surprise, surprise. A company that people have asked about a lot is Zoom. This is a Zoom thing right now. Love the product. The valuation is way too high. And let's see here. And then more messages have come in. What have you heard about large-scale testing? There are many, many companies coming out with tests. The FDA has struggled to certify them all. So part of the problem is that what if it's a company that claims to have a test, but it's not a good test? You get a false negative, you get a false positive. So we're just gonna have to wait on that. It's gonna take a while to sort through. June, July, we might hear. And let's see if any more questions came in. I think I got all the questions. So thank you, everybody. Thank you for coming out tonight. I know it's Easter, and I would prefer not to be speaking on Easter, but the virus and the stock market will not wait for us. So I had to get that out. If you came in late or you want to forward this webinar to somebody else, it will be live on our website, or the recording will be on our website by about 8 p.m. tonight. And we'll send out a reminder email about that as well. And have a pleasant evening.